Welcome to the Mindful Fire Podcast, a show about crafting a life you love and making work optional, using the tools of mindfulness, envisioning, and financial independence. I'm your host, Adam Cuello, and I'm so glad you're here. Each episode of the Mindful Fire Podcast explores these three tools through teachings, guided meditations, and inspiring interviews with people actually living them to craft a life they love. At its core, Mindful Fire is about creating more awareness and choice in your life. Mindfulness helps you develop self-awareness to know yourself better and what's most important to you by practicing a kind, curious awareness. Envisioning is all about choosing to think big about your life and putting the power of your predicting brain to work to create the life you dream of. And financial independence brings awareness and choice to your financial life, empowering you to make your vision a reality by getting your money sorted out and ultimately making work optional. And here's the best part. You don't have to wait until you reach financial independence to live out your vision. Mindful Fire is about using these tools to craft that life now on the path to financial independence and beyond. If you're ready to start your Mindful Fire journey, go to mindfulfire.org/start and download my free envisioning guide. In just 10 minutes, this guide will help you craft a clear and inspiring vision for your life. Again, you can download it for free at mindfulfire.org/start. Let's jump into today's episode. Susan, welcome to the Mindful Fire Podcast. I'm so happy to have you here.
Thanks. I'm happy to be here.
Yeah, I'm really excited to get into our conversation today. We're going to talk about your journey to creating financial independence in your life. And we're also going to talk about some tax strategies that we can all use to think a little bit differently, perhaps, about our biggest expense during our earning years, which is our taxes. Susan and I caught up a couple weeks ago after she reached out, and we had a great conversation. I said, we have to bring this to the podcast audience. And so I'm really glad to have you here today, Susan.
Thank you. I'm so glad to be here. And I feel like taxes, it's a topic that a lot of people just put their head in the sand and they don't really want to think about, but it's such an important part of your wealth building journey that I think it's important to at least get your head around the basics of tax planning so you understand what's going on with your money and how to keep more of your money.
I would love to keep more of my money. And I know a decent amount about personal finance and all of that. But yeah, I would say my head's in the sand, when it comes to tax strategy. I have a CPA I work with, and that's good, but I don't think much about tax planning. So I'm excited to hear kind of how you think about it and what we can bring to the audience, how they can think more about it as well.
Yeah. And that's an interesting point that you bring up too with the CPA, because I hear that a lot. Oh, well, I have a CPA and I just send all my stuff to them. But in reality, typically your CPA is not doing any tax planning for you, right? I mean, they just take your numbers, whatever you've done during the year, and they put them into their software and it spits out your tax forms. So they're not doing things like investing in retirement accounts for you, buying real estate for you, opening a business and deducting business expenses for you. Like, they're not doing any of the things that actually can save you money on taxes. I think it's really important to be proactive and really be empowered yourself, even if you have a CPA. And another thing is that from a liability perspective and a work perspective, it's not doing them any favors to do a more tax planning for you and tax strategy and do extra paperwork for loopholes or, any of these extra strategies that you could do, because it's more work for them and it is more liability. I think that's why it's really important for you to take control of your taxes.
Yeah. And so we're going to dive way deep into that. Believe me, I'm going to bring a lot of questions for you, Susan. But before we get to that, I want to invite you to just share a little bit about who you are, your journey, and what you're up to these days.
Yeah. So I am Susan Geist. I live in Austin, Texas with my husband and 2 sons. And we reached financial independence about 3 years ago. And we both early retired from our W-2 jobs, which has been really nice. Right now, I'm running a business with my business partner, Caitlin Muldoon, Rising Femme Wealth, where we help women step into their financial empowerment and kind of design a life that they love using the financial tools to get there. It's been a really interesting shift and journey along the way. I would say I don't come from money. And so, it's been challenging at times. I grew up in the mountains of East Tennessee in a small town. And there were really, I would say, like 3 critical sort of crisis points in my life that really shaped my financial independence journey. The first one was losing my mom at a young age. She and my dad were not in a good relationship. She was a stay-at-home mom and she never had any of her own money. And so she couldn't really do the things she wanted to do or be the person she wanted to be. And then she died young. And I told myself that I never wanted to be in that situation. I never wanted to be beholden to a bad person or a bad situation or a bad job because of money. That was my first real sort of pivot point towards I need to be financially independent. I need to have more than one source of income. I can't rely on one person to support me or one job to support me. And then I would say the second real crisis point for me was after I had my first son. I wanted to step back a little bit. And so I went to my boss and asked if there would be some part-time opportunities, at least for a little while, so I could spend more time with my son. And he said, absolutely not. I mean, your time belongs to us. And it was organizational policy. He wasn't a bad person, but that was just how things were. I think it's how most workplaces are, right? There's not a lot of flexibility. And so that was when I realized, okay, I really need to start working on having other streams of income. And it was just a few months after that when I bought my first duplex. The third crisis point for me was in 2021. We're getting very close to financial independence. And I was doing our taxes and we had a tax bill that was $137,000, just our federal tax bill, which was considerably more than I was making at my W-2 job. And I was like, this is ridiculous. What is going on here? Because yes, we had W-2 income, but we also had real estate losses and we had stock losses that year. And I couldn't understand why these weren't offsetting each other. And so that is what made me start getting into tax strategy and to start looking at, well, how does the IRS actually look at income? How is this set up on their end? And what can I do to change that? And so the next year, I was able to get our federal tax bill down to about $6,000 with more income coming in. 2023, I finally hit the elusive $0 tax bill. And then 2024 was also $0.
Wow, across the board. Holy moly. The story, the pivot points, but also, I mean, you finished strong with the 2 years of zero tax bill. That's not how I've been operating, and I would like to be, because that would be a lot more money staying in my pocket. So, yeah, thank you for sharing the background and the pivot points that you had in your life. Sounds like 3 rather large wake-up calls that really pushed you towards wanting to have FU money, right?
Yeah.
To be able to own your time, own your life without having to rely on anyone or anything to make sure you can live that life. I think that is what attracts a lot of us to financial independence and the FIRE movement. So you mentioned, Susan, that one of the things that you are focused on now is supporting women with Rising Femme Wealth to step into their financial empowerment. I guess let's start at the very basics. Like, why is it so important for women specifically to do that?
So I think historically, women have often not been given the same opportunities from a financial perspective. Culturally, right, we've seen this shift from women being expected to sort of be the servants of the home. Now women can have credit cards and have jobs and all of that, but they're still oftentimes behind, right? We know that the salaries for women are lower than for men. Women do tend to be more often in lower paid fields. And I feel like women don't get as much exposure to financial topics, both in school and in social environments. I know, when I was working at an office, I was the one talking stocks and real estate with all the men, right? Like it was the men having these conversations. There were no other women that were in these conversations. So I think it's really important to open that door. And the first thing that we often do with a lot of these women is we say, okay, let's unpack what you have. Let's look at your 401k, your IRA. Let's dig all these up. Let's sign into these accounts. Let's see, okay, what are you actually invested in? What are the fees on your investments? And that's actually an amazing first step for a lot of these women. They feel so empowered being able to take control over that, being able to understand how to use all of these tools, where their money is, what their options are. And so I think, that empowerment is what can really sort of build women and help women lead into the next generation and beyond and start getting more power. Money is power, unfortunately. We're definitely seeing that now. And so the more money that ends up in women's hands, the more empowered they feel around money. I think we can really help women have 50% of the voice like they should have, right?
Absolutely, that makes sense. I really like what you said about, having 50% of the voice, and money is power. Like you said, we are seeing that in a big way where one person can essentially influence an entire election because they have unlimited money. And so when normal people like us, have money in our pockets, we can make our voices heard through all sorts of ways, but even just, navigating and operating in the world. And, it kind of hits close to home for me because, as we talked about in our last conversation, my mom growing up, she earned money and she's an entrepreneur and she's very good at earning money. But when it came to investing and understanding the finances, she, for lack of a better word, stuck her head in the sand and let my dad handle it. And fortunately, things worked out okay. She never, every once in a while, she would get annoyed about a decision that she was not involved in. And it's like, you need to own that. You need to be part of the conversation. You need to understand how much you have, where it's going, what we're doing as a family. And I think that it can seem overwhelming at first. I mean, certainly for me, when I was getting into personal finance, until I read The Simple Path to Wealth, I was like, I don't know. So I'm just going to wait. And fortunately, I wasn't spending all my money. But I think that a lot of people and a lot of women also have this overwhelmed feeling. So they just said, I'll figure it out later, or I'll let my husband handle it and I'll just do my thing. But it's so important. And you never know what is going to happen in life. Your husband could pass away. You could get divorced. Things could go south in the relationship. And you don't want to be in a situation where you have to start from literally nothing.
Yeah, we get a lot of women that come to us and they are, middle-aged or a little bit older. And that's exactly why they're getting a divorce, or they suspect that their husband is about to leave them, or they are planning on leaving their husband. Or we've had women whose husbands are older. And so they're like, at some point, I'm probably going to be alone. How do I handle this money? And so those are issues that we confront a lot, like big life changes that leave women in a position where they need to know how to handle the finances.
If you were to give a piece of advice to a woman who's listening to this, what would your advice be for them to step forward into their financial empowerment? Where would you recommend they start?
Yeah, I mean, I think knowledge is always power. Even if you decide not to do anything with the knowledge that you have, and I even say this, with the tax strategy too, just having the knowledge is power. Knowing your situation, knowing what accounts you have, knowing where your money is invested, when you can access it, that is empowerment. One of the things that we do with women right at the beginning, even so before we meet with them, we have them set up a simple financial tracker. They record their income, all their sources of income, their expenses, and their investments. And so right there, they've got a snapshot of everything that's going on with their financial life. And that, I think, is one of the most empowering things we do. with women. And it's so basic, but it's just something as women and really anyone, like we're busy, right? Like it's hard to take the time to sit down and actually untangle all of that. But it's so essential, and it's such an important first step to just, get a baseline. Where am I at right now with my finances? And then we can start figuring out, okay, what do you want your life to look like? How much money do you need to be able to buy your time back? Do you want to work part-time? Do you want to be able to switch careers? Do you want to not work at all? Do you want to take summers off? Like, what do you really want that to be? And so we take that baseline, and then we can sort of pull levers on that, right? And figure out, okay, how do we get to this life that you really want to live?
I love that. And obviously, you support women through the work that you do. How can people reach out to you and start with that financial tracker?
Yeah. So you can visit our website, www.risingfemmewealth, that's FEMME.com. And we have a lot of information on there. We have a free weekly newsletter. And for listeners today, I actually have a free Tax Smart Financial Independence guide. If you go to risingfemmewealth.com/mindful, you can download it there with some tips on how you can implement tax strategy into your own plan and potentially start keeping more of your own money.
Very good. We will certainly link that in the show notes, and we'll have you mention that at the end. But let's get into it. Let's talk tax strategy. So you can assume I know nothing, and I don't know where you want to start, but I want to be schooled. So let me know where we should start, Susan.
Yeah. So before I start, I just want to make clear that this is all just for educational purposes only. This is not personal financial advice, and you should always consult the appropriate professionals for your own unique situation.
Thank you so much. Now let's get into it.
So an important piece of tax planning, and this was really the aha moment for me, because I had mentioned earlier in our conversation that we had a lot of income coming in from W-2 jobs, and we had a lot of losses in real estate and stocks, and I couldn't understand why they weren't offsetting each other. So what I developed was this tax bucket planning method, which is a visual way to lay out your taxes, which I know visual is maybe not the best medium for a podcast, but I'll try to explain it. And you can see more of it on the freebie that's linked in the show notes. But the IRS actually divides your income into 3 different tax buckets. And these are distinct tax buckets. So the first one is active income, also known as earned income. And so this is where you'll see like your W-2 income, 1099 income. If you have like a small business that you're running through your personal tax return on Schedule C, all of that'll be over in this bucket. If you're doing withdrawals from your 401k, that'll end up in this bucket because that originally was income, active income. And then the second bucket is the portfolio bucket. And so this is going to be like if you have stock sales, dividends, interest, things that you normally think of as your paper portfolio. And then there's the passive bucket. And so if you have rental real estate, usually it's going to end up in that bucket. And this will be other businesses that you're invested in passively. So if you're getting a K1 from a passive investment, a lot of times that income is going to be over in this bucket. And so what I didn't realize before I started doing this was that these really are distinct buckets. And so you need to look at which buckets your income is coming into and pair deductions in that same bucket. So what happened to me was I had all of my income in this active bucket and all of my losses in the portfolio and passive buckets, and they weren't able to offset my active income. And so what I ended up doing the next year was saying, okay, how can I shift things around so that my income is actually offset by certain deductions that I can have?
Got it. So you have 3 types of income that are in distinct buckets, and the deductions that can reduce that income needs to be in the proper bucket to actually reduce the income of that bucket.
Correct.
Got
Yes.
it. And active income is essentially you're working, you're trading time for money and
Right.
actively earning the money. Can be through a business, but that business would be something that you are actively working on. Like, so my business is essentially an LLC, and I am doing consulting and coaching. My time is being used for money. And so it's in that bucket still as a business. Now, the reason I ask in that way is the third bucket you mentioned is passive bucket. Real estate, why is real estate in that bucket versus it being a business? Because like theoretically, you could be fixing up a house, you could be finding tenants and fixing toilets and all of that. Feels pretty active to me.
I agree. Owning real estate myself, I definitely agree that there is really nothing passive about it. But this is how the IRS has classified real estate. It's a fairly recent change within the past few decades, but now long-term rentals especially are classified as passive income. And so, but one of the tools that I was able to use, so the IRS will actually allow you to classify short-term rentals as an active business if you're managing them yourself. And so you can actually take the short-term rental and move that to the active bucket. If you put in enough hours of time, you're the main person doing the work on that short-term rental. And so that was a huge tax savings for us. And that was a big part of us getting our tax bill down. We had 3 short-term rentals that I was managing. And so we were also able to take bonus depreciation. So, with real estate, you have to take depreciation. And typically it's on a standard schedule, either 27 and a half years or 39 years, depending on the type of asset. But there's the ability to take bonus depreciation sometimes comes along with the legislature. And at that time, it was in place. I think it's coming back. It's in the current bill to come back this year, 100% bonus depreciation. And that allows you to accelerate your depreciation deduction. And so any assets within your property that are typically depreciated in 5 or 15-year periods, you can group those and take them all up front. So for me, on one of my short-term rentals, I was able to take $160,000 as a deduction on my taxes against my active income because I was managing that short-term rental, and I was able to offset my W-2 income with that deduction through bonus depreciation on my short-term rental.
Got it. And what was being depreciated? Like, I have a vague understanding of what that means. So I assume people listening to this that aren't as intimately invested in real estate also might be wondering what is depreciation? Let's start there. And then what are things that you can depreciate? You don't have to give me your exact situation if you don't want to.
No, that's a good question. So you can think about depreciation like when you buy a car. And so your car is not worth as much. Well, pretty much the second you drive it off the lot, it's not worth as much, right? But year over year, it's losing money. It's, not in as good condition. Things are wearing out. It's depreciating in value. And so the way real estate is set up is the government depreciates it, even though logically, typically real estate appreciates, right? So it kind of doesn't make sense, but it's how it's set up. And so
but it's like the full price. It's like you buy a house for $100,000. It has some land. It has a house on it. You're depreciating everything? Or is it just the house? Or is it
the building value?
Just the building value. Okay.
Right.
Yeah.
So typically
it's like if the land is just the land.
Right. Because the land doesn't really lose value, right? It's just the land. So typically what I'll do is I'll go into the tax records and I'll see how they've split percentage-wise the land and the building value. And that's what I'll use to determine what my beginning depreciation amount should be. And then I'll do a cost segregation, which is you do a study where you go through the property and you look at, okay, which assets are going to be depreciated in 5 years, which are going to be depreciated in 15 years. And so 5-year assets, those are going to be things that wear out pretty quickly. So like a lot of your appliances, blinds, ceiling fans, some flooring, things like that. And so that's what'll be recorded on the cost segregation, right? And then 15-year assets are typically going to be like landscaping assets, so like decks, patios, things like that typically do wear out a little faster than the house would wear out. What this does, the bonus depreciation, you'll add all of that up and you get to take that depreciation altogether at
all
once
at once.
the first year. You still have some standard depreciation the rest of the time too. You just get that big bulk of depreciation in that first year. And so one strategy that I've done with my short-term rentals is I've actually moved them over to an active business for myself that first year, where I deduct this big bonus depreciation. I get to use it against, at the time, W-2 income, and then move it back over to the passive bucket by getting like a property manager. And then it becomes a passive asset again. I'm still getting a little bit of depreciation, but my big bang for the buck I already used.
It's just that you were actively managing it in the year where you're taking the deduction.
Correct.
Got it.
Yes.
So you're tax planning to take advantage of that, right? Like now you might be thinking again, because the tax bill, whatever, is going to have that potentially in there. If that does come to fruition, then you're going to potentially set your life up and your businesses up in a way where you could take advantage of that.
Correct. It made sense to move it back to my passive bucket because we've been selling off our short-term rentals lately, and we have a lot of passive carryover losses in that passive bucket from other things we've depreciated. So when you invest in like real estate syndications, like an apartment building, there's like a limited partner, a lot of times they're taking bonus depreciation too. And so you get this write-off up front. And so when we sell our short-term rentals, instead of having to pay the capital gains, we can go ahead and use that write-off that we've already got sitting in that bucket. So I needed to move it back over from active because otherwise I would be stuck with this big tax bill. So I had to move it back over to passive, sell it,
the sale,
and then absorb that sale with other depreciation, right? And so it's like a shell game.
The active managers of that business are taking, but you as an investor, a passive investor, can pass back to you. Couple questions about the depreciation before we move on. You can only do this one time, right? Like if you're doing the bonus depreciation, you're going around the house, sounds like you're making a spreadsheet of the floor, it's worth this much. The blinds, they're worth this much and they depreciate over this period of time. The fridge, the deck, all of this stuff, you're making a list, right? Is that correct?
Essentially, yes.
Essentially making a list. And then you're taking that amount, you're depreciating the full amount of what those are worth right away? Is that?
Essentially. So there are online tools that help you do this. And so
I would hope
that's
so.
what I use. Yeah. You can also hire an engineering firm. That's going to be really expensive. But if you have a big property, like an apartment building, you're definitely going to want to hire an engineering firm.
Right.
If it's just like a short-term rental, one short-term rental cabin or whatever, you can definitely do the online version.
But you're basically saying, like, I'm not just making up these numbers.
Correct.
This trusted source is telling me that this amount of flooring is worth this much if it's this age. And when we're talking about the bonus depreciation, you can take 100% of that value in that year. So instead of doing it over time, is that how that works?
For those 5 and 15-year assets, yes. So you can't take the full. In that case, it was a 39-year depreciation. Right. So that's why there's still some standard depreciation every year left. Right.
And is that the difference? Is that like, because if you're depreciating the floor and the blinds and the fridge and and the deck, right? Like what's left is basically the walls.
Correct.
And the room.
So it's what's left still being depreciated over the 27 and a half or 39 years. And
so
the 100%, the 100% depends on what the legislature puts in the bill. What we've seen the past few years, so we had 100% depreciation and then it started dropping by 20% every year. So it was 80%, 60%, 40%. But now it looks like it's going to come back at 100% again. So that's definitely something to be aware of because it's going to make a lot more sense to do a cost segregation and bonus depreciation in a year where there's 100% eligible versus 40% eligible.
So you'd want to plan and take advantage of it right away.
Right.
Yeah.
Or in a
whatever
year,
it goes into.
You can actually hold off. You can buy it in 1 year and then whatever that eligibility was for that year, you can do it later on if you need to.
From when you bought it?
Yes.
I see. Okay. Definitely in the weeds. I told you I'd have questions. Cool. So I understand that. While we're in this bucket, this earned income bucket, are there other things people should be thinking about to offset their taxes?
Yeah. So, I mean, the first thing, of course, is the low hanging fruit, right? The tax advantaged accounts. So that's going to be your 401k, your IRA, HSA, things like that, right? That give you some sort of tax benefit immediately. And so that's where we typically start with clients. We're looking at, okay, well, let's hit this low hanging fruit. What are you eligible for? Are you taking advantage of it? Does this make sense? And then we can start getting into some more complicated strategies. Like I mentioned, this short-term rental loophole. Also, there's like real estate professional status. That's another thing that allows you to move one bucket to another bucket. With real estate professional status, we usually see this with married couples because they'll be filing jointly. And so typically one of them will have a W-2 job, the other one won't. And so the other one will take the steps to get qualified as a real estate professional. And so typically they own rentals, they're managing those rentals, they're doing something in the real estate space that qualifies as their primary business. And at that point, the IRS sees it as a small business. And here we go again. We can take everything in that passive bucket, move it over to the active bucket. So all of those real estate losses now can be used to offset the partner's W-2 income. And there's even a way to do a grouping election to group in like real estate syndication investments into that real estate business and move that whole thing over once you've got your real estate professional status. So you do have to be doing some active real estate. You can't just be syndications, but then you can dump that whole bucket. And so we see a lot of couples that are in that situation where one has, a high paying W-2, the other one is managing the real estate portfolio, and they're paying no taxes because of the real estate write-offs every year against that W-2 income. So we start looking at strategies like that. Does that make sense for people? And then, of course, the business aspect. We've talked about how the small business income is coming into that bucket. Are you accounting for your expenses correctly? Are you taking advantage of everything you can write off? Are you writing off, a home office or your internet, car, just different aspects that a lot of times people have forgotten about or don't realize are really actually a part of their business. So we look at that, and we look at whether people actually have a business that they don't realize. A lot of people are doing side hustles, but they haven't realized, I am making money off of this. This is a business. We help them actually incorporate that right into the tax return, right? On Schedule C, well, you need to be writing off your expenses for that too. So that's another way that they can be working on that active bucket. It is a hard bucket to work with, especially if you're just W-2. If you're just W-2, you don't have a whole lot of options. If you think about how the taxes are set up, there's two different paths, right? So you've got your W-2 path where your taxes are taken out, then you get paid, then you pay all of your expenses. You've got this other side, which is like business and real estate. You've got your expenses coming out first, then you pay your taxes. So the more income you can get in that other side where you get to deduct your expenses first, the better from a tax perspective. It's talked about in Rich Dad, Poor Dad by Robert Kiyosaki.
It's definitely got me thinking. I mean, I'm certainly doing the business aspect. I was doing it as a side hustle. I am doing it now as a full-time entrepreneur. I guess a couple things that I'm wondering, I'm probably not taking as many deductions as I should. Basically my tax preparer or whatever years ago was like, the home office thing is not worth doing because it raises your audit risk. Is there any truth to that?
Anything on your tax return can raise your audit risk. I think most people's audit risk is pretty low. And I think most people have good intentions with their taxes. And so I think what the IRS wants to see, and I think a lot of people are just scared of audits in general, but the audit process is not exactly what I think people imagine it to be. I think people imagine that the IRS is knocking on their door and they demand all of your paperwork for the past 20 years But typically, the IRS first will send you a letter in the mail just about one aspect of your tax return, right? And they'll say, we have a question about this one particular line on your tax return. Can you just provide us some information on this? So it's not as scary as what people think. And also, like I mentioned, the IRS wants to see good intentions. And I get this question a lot with small businesses. People will ask me, oh, well, I'm just not making very much money in my business. Are they going to come audit me? What the IRS wants to see is that you are actually trying to have a business. And if you can show that you are trying to have a business, typically that's good enough for them, right? Like, are you investing in that business? Do you have a website? Are you investing in some marketing or some training or something, right? It's not just a hobby. And so if you're using your home office, then that is a valid tax expense that you can write off. But again, like I said earlier, a lot of CPAs, they're just lazy. It's more work for them. They're probably not getting paid anymore to go through that paperwork for you. So it's just easier to say, don't worry about that. That's just, it's a liability. We don't need to put that in, right?
That makes sense.
And this is why I do my own taxes. So my tax return last year was over 400 pages, but I still do it myself.
Well, you paid zero in taxes, so I think that's worth the effort.
Yeah, I want to be in control over it. I want to know exactly what numbers are going in there and what I can take advantage of.
Okay, I guess another question on that front, I guess I'm wondering, should I be doing like a solo 401k now that I'm a entrepreneur, LLC, basically? I see the benefit of not paying taxes on that $20,000, but also maybe I need that $20,000 to live on. It might be a considerable savings, especially if I can, have matching and like I can have more of it than the 20,000.
Right. That is definitely a dilemma. When you're looking at early retirement, is how much do I actually put in my retirement fund versus like a taxable brokerage account? And that was something we had to balance. There are some options once it's in the retirement fund. So we do a lot of Roth IRA conversions. I don't know if you're familiar with those.
I am, but if you could just briefly explain it.
Yeah.
I just want anyone who's hearing this, they're going to want to know. So we want to make sure that they know. This is a good one too.
Yeah. So we do like a standard Roth IRA conversion most years. So this allows you to take money from your traditional IRA, which is pre-tax, and roll it to a Roth IRA. And then you pay the taxes at that time when you roll it. And it's a really good tool to use in early retirement, or like if you're taking a sabbatical, or if you've been laid off, you have part of the year where you're unemployed, essentially when your income is lower than it typically is and your tax rate is lower than it typically is. So say, you were working a high power job in a 37% tax bracket, but then you suddenly get laid off, you have a year of unemployment, your tax bracket is now, say, 12%. That's a great time to take some money and roll it over when your tax rate is a lot lower than it would have been otherwise. That's the standard Roth conversion. It's something it's very popular with early retirees, and that is a way that you can access your money, your retirement money, more quickly. You do have to wait 5 years after rolling it to be able to access it, but then you can access your contributions at any time, tax and penalty free. You have to wait to access the growth till you're 59 and a half.
Can I do that if my wife still has a high income?
So it's not going to be as valuable because you're probably still in a pretty high tax bracket. But yes, you can do it. Anyone can do it.
I guess the underlying question is like, can I do like married filing single or whatever, not jointly, whatever the opposite of jointly is?
You could, but I would not recommend filing separately. Typically, that's not going to get you your best tax outcome. Really, the only cases where we see that gets a better tax outcome is if one person has like a lot of student loans or a lot of medical expenses that would allow them to itemize. Otherwise, the numbers typically don't work out to file separately. So I would recommend filing jointly, but you can still do the Roth conversion. But if your wife is thinking about leaving her job at some point, that might be the time to start doing your Roth conversions.
One more question on that. Like, to do that, to really benefit from the super low tax brackets or zero tax bracket, there's a certain amount that you can roll over without taxes, but that would assume that your income is almost zero. So I guess like this doesn't work with like if your expenses are pretty high. Like the Roth conversion strategy, does it necessitate relatively low expenses?
Like income?
Like let's say you're early retired and your life costs $100,000 versus $200,000 a year. You're going to need to take that money out. You're probably going to have gains, or you're going to take that out of retirement account, assuming you're of age to do that. Like that is going to reduce your ability to take advantage of those low tax brackets on a conversion.
Not necessarily. And there's actually an example of this in my freebie that's linked to this podcast. So I show an example in there of a married couple with 2 children under 18 that is early retired. And so how they are drawing down their income, they are maxing out the 0% capital gains tax bracket, which for 2025 goes up to, I think, 96,700. And that is long-term capital gains, right? So they can they're drawing down principal, and they can draw down that much in gains and still be in the 0% tax bracket.
Right. So that could be, if there's a lot of gains, that could be $200,000, $300,000.
And they can actually draw down more, which you'll see when you look at the example, because they get 2 child tax credits that are worth $4,000, and a credit comes off your taxes rather than a deduction, which comes off your income. And so they actually were able to push that up to, I think it was 123,000 in capital gains. And then they did a Roth.
15 kids?
Well, they have 2 kids. So it's the actual tax. So it's the 15% tax rate on the difference between 96,700 and 123,000 came out to about 4,000, and then it goes to 0.
Got it. Okay.
And then they did a $30,000 Roth conversion to use their standard deduction. They haven't used the standard deduction yet.
They haven't touched that yet. That was just the capital gains.
Yes. So they're moving $30,000. That's where the Roth conversion comes in. So they use that standard deduction. They're in the 0% capital gains bracket. They get their child tax credit for the 2 kids. And so they've been able to draw down principal plus about $123,000 in gains, long-term capital gains from their account, and do that Roth conversion, and they have a 0% tax rate. And that's what we see with a lot of early retirees. Right. I actually am doing something very similar to that with my portfolio right now, except I also have a lot of stuff happening in the passive bucket with all my real estate and write-offs and a lot of stuff churning over there too.
Yeah, we should probably move on. But thank you. Yes. No, very good to think about. So I guess just closing the loop on the 401k, like, does it make sense for me to look into getting a solo 401k and contributing to that to reduce my income? Or do you?
Yeah, I would definitely look into it. You can look at a solo 401k. You can also look at a SEP IRA. That's the other alternative.
I had one of those before. Yeah.
Yeah. Who are self-employed, and see which one might make more sense for you. You can't have a solo 401k if you also have one with your W-2 job. So that's something to keep in mind if you were to go back to a W-2.
If I still have an old one that I'm not currently contributing to, can I have a solo 401k? That's okay. Yeah. Okay, I'm going to stop making this all about me, and we're going to move on to the second bucket, which is, you said, is like the portfolio paper assets.
Yes.
So what can we do there?
The portfolio bucket, there unfortunately are not a whole lot of tools. The good thing about the portfolio bucket is you get to take advantage of a different set of tax brackets. Like I was mentioning before, these long-term capital gains and qualified dividends tax bracket, which tends to be lower for most people than their standard ordinary income tax bracket. So those tax brackets currently run from 0%, 15%, and 20%. So that's a huge advantage of income coming from this bucket. It's something that a lot of people who are financially independent take advantage of, like we were just discussing, using that 0% tax bracket to their full advantage. Another thing that you can do in this bucket, and this is probably the most powerful tool in this bucket, is tax loss harvesting. And so that is where you can offset your gains with paper losses, usually in the stock market. And so this is kind of a common theme, right, that we've been talking about with these tax tools is generating paper losses. That's essentially what depreciation is. It's a paper loss. And so that is also what tax loss harvesting is. If you do it correctly, it's a paper loss. So you'll go through, if you have gains in your portfolio, you can go through and look for losses to offset those gains, and you sell those assets. And then you buy directly back into the market, but not the exact same thing. And it's considered a wash sale and it doesn't count. So you want to buy something that is different, but you can buy things that are similar. So a lot of people will go back and forth between like a total stock market index fund and an S&P 500 index fund, which the IRS has said are two different funds because they're using a different index, but they're very similar. They move very similarly in the market. So you could harvest losses on one, buy back into the market. You still got the same market exposure that you had before, but now you've got this paper loss that you can use to offset your gains. And each year, $3,000 of that can actually be moved from that portfolio bucket to your active bucket. So there's another strategy you can use against active income. It's only $3,000, but it's something, right?
Yeah. If you're in
So
the
a lot of people
40,
will just do
40
that.
to 45% tax bracket between state and federal, that can be, $1,500 in your pocket.
Yeah. And it doesn't have to be necessarily offsetting stock gains in that bucket either. So I was in this very strange situation a few years ago where I had bought a rental property to renovate and then rent out. It was supposed to be the BRRRR strategy. And so we started renovating and we got caught in the COVID shortages. Like we couldn't get the supplies we needed. We couldn't find workers. It ended up taking us over a year. The market was starting to soften. And so we ended up deciding we needed to sell that property. But we weren't house flippers. It wasn't an active business for us. So that income from selling that property wasn't in our active bucket, but we never used it as a rental. So it wasn't in our passive bucket. It was stuck in our portfolio bucket. It was like an investment asset. So I had this $70,000 gain coming into this portfolio bucket. And so that was when the stock market had fallen because of COVID. So I harvested $70,000 of losses, created paper losses in my stock portfolio to offset all of those gains that year. So you can use it as kind of a really interesting tool to offset different kinds of capital gains that you might have.
Yeah. Interesting. Yeah, I haven't done too much of the capital loss harvesting. I've definitely offset gains with losses by getting rid of individual stocks I shouldn't have bought in the first place. One thing that always prevented me from doing that is the dividend reinvestment. Do you set your dividends to automatically reinvest or not? Because those are technically purchases,
right?
Which could trigger a wash sale. It's like 30 days before or after, right?
Correct. Yep. That is a really good point to bring up. I do not have my dividends reinvested, partially for that reason and partially because I'm living off of them. That was the main reason. But yes, that is a really good point to bring up because I have seen people get caught in that where they don't realize they've actually purchased that very same stock that they're selling within the past 30 days because they didn't actively purchase it. They just had their dividends reinvesting in the background.
Mm-hmm.
So I'm really glad you brought up that point because that is something that people need to watch out for if they're doing tax loss harvesting.
Is it a similar thing if you get stock from your company? Do you know about that? Like I was getting Google stock and stuff like that when I was an employee as part of my compensation. And I was thinking that those are like technically, I don't know if they're purchases, but I kind of thought they were treated the same way.
Yeah, I would imagine so. I'd have to look into the specifics of how that particular stock trade was set up. But yeah, that's definitely something to be aware of if you're getting company stock that's being purchased at that time. Another thing you can do, I'll see a lot of people who are financially independent do this, or people that have losses to offset. You can do tax gain harvesting. I don't know if you've heard of that.
I have, yeah. Tell me about it though.
You actually can go ahead and reset your cost basis. You sell things that have gone way up in value and you harvest those gains. So if you have a lot of losses, maybe, you took a big loss on some asset that you sold, you can go ahead and harvest some gains, reset your cost basis. So say you bought Google at $10, it's now $100. Well, you can reset that cost basis, go ahead and absorb that $90 gain at a very low tax rate because it's being absorbed by these losses that you have. That's another interesting tool that you can use that a lot of people don't think about. And there's no wash sale rules on that. So you can just immediately buy the same thing.
Got it. So you could like tax loss harvest some losses for things that have gone down and effectively just move it over to a different, similar, but not the same fund to avoid wash sale. Then you have those losses. You could offset something that went up with capital gain harvesting on that as well?
You could. A lot of times I'll see it where if people just have something else that has created a big loss for them. I've seen people sell like classic cars, but it's not really a business for them. It's just an asset. So they'll maybe have a classic car they've restored. Maybe they've sold it at a loss because the market's gone down, and they can offset that just by doing some tax gain harvesting, things like that. Or if you're trying to offset your standard deduction and you can't do a Roth conversion for some reason, another tool in the toolbox, right?
Right. And of course your income dictates what you can do and how much you can do with that, right? Because
Right.
if you're in the super high tax bracket, yeah, you can do it, but you're going to pay 25% capital gains on it this year. But if you're in a low tax bracket and your capital gains rate is 0, then you can do it without having any tax implication. Potentially.
And this is another reason why it's so important to understand the buckets, right? Because you might be saying, oh, well, I've got all this W-2 income. I'm going to do a bunch of tax loss harvesting, but that's in a different bucket. And so that's why these buckets are so important to get your head around and understand, okay, this is where the income and the deductions come in and out of.
Yeah. Very helpful. Very helpful. All right, Susan. So let's switch gears now into the third bucket. And this is the passive income bucket. So what can we do there?
Yeah. So a lot of these deductions are going to be related to real estate. Real estate has huge tax advantages. And just kind of a sidebar on this. So one question that I do get is, should I feel bad about paying less in taxes? Something that I'll say about this is that the government has set up tax incentives to incentivize people to do the things that they want people to do. So they want people to provide housing. They want people to create businesses. And this is why you'll see so many tax breaks in these areas. And so that's one reason why we see so many real estate tax breaks. And then another thing I say to that is you're probably paying a whole lot in other taxes outside of just federal taxes. So you're probably paying a lot of property taxes, sales taxes, gas taxes, all sorts of different taxes, right? So you're probably still paying a good amount in taxes. So I don't know that it's worth feeling bad about using strategies that are available to you and are perfectly legal. So here in the passive bucket, you'll find a lot of real estate tax breaks. So we already talked a lot about depreciation, which is, again, this paper loss that you can generate on your tax return that can be very valuable if you have other income coming in to this passive bucket. And then there are other things you can do, especially with capital gains in this bucket. And so capital gains, we've talked about this a little bit. Those are one of the sources of income that actually can transfer between buckets. But one thing that is particularly powerful in this bucket is being able to do a 1031 exchange, which is where you can take your piece of real estate and you upgrade to a different piece of real estate and you defer paying those capital gains taxes. And you can keep rolling that indefinitely. And you'll see a lot of really wealthy people will use this as a strategy. And when they need money, they will just borrow against those properties or do a cash out refinance. They won't actually ever exit the 1031 exchange path that they're on, right? They just keep exchanging. Then they die. The cost basis is reset for their heirs. And then suddenly there's all this generational wealth that was created. And that's where a lot of families who have wealth now got their wealth from in the past. Was from these big real estate portfolios that passed on to them.
And just a question on that, like you can borrow against these assets, essentially. You're just using them as collateral and taking out a loan from a bank, or?
So yes, in certain ways, you can sometimes do a form of like a home equity line of credit. There are a few that will do loans on rental properties. Once you get to a certain level of wealth, people will loan against your assets. So as your pool of assets gets bigger, you're able to pull more money out. And you can always do like a cash out refinance if you need to, too, on these assets. And then you can also do this once your brokerage account gets high enough. You can do a securities-based line of credit. I have one of those, and I actually use it to purchase real estate. So you can borrow money against your stocks.
And there's an interest rate on that.
There is an interest rate on that, but it's usually pretty competitive. The more money you have, the more competitive that interest rate is going to be. It's like this horrible cycle, right? It's like the richer you are, the more free stuff you get.
I know. It's so true. It's very expensive to be poor in America. That's what I have heard and noticed. I've heard this. I think I read an article one time in the New York Times or something about how Jeff Bezos can buy a $500 million yacht without selling one share of stock. It's because every bank will give him a loan, basically nearly interest free, to take that $500 million, do whatever he wants, because he has $200 billion of assets in Amazon stock sitting on the side. We get the taste of what we can do, which is not that. But what else can we do?
So the 1031 exchange is powerful. You can also do essentially like a lazy 1031 exchange, which is definitely easier from a paperwork perspective. By selling an asset, you've got your capital gain, but you buy a new asset and you do accelerated depreciation or bonus depreciation up front. And so you're essentially deferring that gain by offsetting it with this new paper loss, but you're not doing an official 1031 exchange. And so it saves you from all the paperwork involved in the 1031 exchange and all the rules involved with that. And then having to maybe eventually exit out of that with all the complicated paperwork, having deferred the taxes and tracked your cost basis all those years. And it gets very complicated. So the lazy 1031 exchange is a better way for a lot of people. And you can even, invest in like a real estate syndication that's giving off a lot of bonus depreciation and use it to offset like a real asset that you've sold.
Is that like a DST?
You can also, yes.
Is that different?
So you can 1031 into a DST, and that's a Delaware statutory trust. Some real estate syndicators run those. So you could do an official 1031 exchange into those. I personally don't like them because they charge a lot of fees. You're not going to get as good of returns as you would get just doing like a lazy 1031 exchange straight into another syndication that's throwing off a lot of bonus depreciation, or buying another property that's throwing off that you can harvest the depreciation from. So in general, I'm not a huge fan of them, but it is something that a lot of people pursue because they're done with being an active real estate investor. And that is an easy way to 1031 into.
Right. And then you get like a percentage payment or whatever, it's like a dividend almost.
Right. Yes.
Yeah. I just know of this because my parents have done that when they sold real estate in the past. What else should I be thinking about here? And I guess like my question is, I do not have any real estate investments personally. Should I?
So that's a great question. So the number one thing I tell people about tax planning, other than that they need to learn about it, is they should not let the tax tail wag the dog. And so when we do tax planning in our Rising Femme Wealth business, we do it incorporated into an overall wealth plan. We've been talking about all these different interesting tax strategies you can do, all these levers you can pull. But when it comes down to it, there are a lot of things that maybe don't fit with what you're looking for in your lifestyle. There are a lot of people that don't want to be a landlord. They don't want to be in the hospitality business doing short-term rentals. They don't want to have their own business. And I think a lot of times you get sort of these talking heads, especially on social media, and they're telling you, oh, you need to go buy this $100,000 heavy SUV that you can write off in your business. And so here you've gone out and you've bought this $100,000 car that you didn't need to save $10,000 in taxes.
Yeah.
Like it just doesn't make sense in the overall scheme of your wealth plan. Yeah. And so I think it's really important. Yes, there are all these tools, but it's so important to first run them through what your life design looks like. Like, what do you really want to be doing with your time? And it may be that just investing in tax advantaged accounts, doing a little bit of tax loss harvesting, that may be the level that suits your lifestyle. And I don't think you should feel bad about not taking advantage of every single little thing and optimizing every single little thing. It's going to drive you crazy. So it's so important to really look at this holistically. And Caitlin and I, my business partner, we used to do a lot of one-on-one tax strategy sessions with people. But we found ourselves in this dilemma where it's like, okay, yes, this strategy could work for you, but is it what you really want? Like, it was really hard to do that separately without like a whole wealth plan and values and goals and knowing all of that. And so we've kind of pivoted. And so we now have a Wealth by Design program that integrates all of it together. You can still do some coaching sessions with us through that, and we can help put together a tax strategy, but we're looking at it through the lens of, okay, these are investments in tax strategies that fit with what I want my life to look like, and these are ones that don't. And I think that works a lot better for people.
Yeah, you have the context and the clarity on the whole picture rather than just the one thing. Yeah, because that's kind of where my head's going. It's like, I could do these things, but like I would need some real estate. It's like, but I don't want any real estate. So
exactly,
what's the point? Yeah, it's funny that the example you gave of like the heavy $100,000 car, it's like the equivalent of people buying things because they're on sale. It's like you're still spending the money, right? And they're saying it's cheaper, but it is what you're paying. You're not saving money. Saving money is not buying the thing, by the way.
Exactly. Yes.
Are there any other things that we should be thinking about in this third bucket or overall?
I think that's the main one, is just to really be mindful of what you want your life to look like and then incorporate the tax strategies that work within that. There are a lot of different ones, and there are some things that are going to fit, some things that aren't going to fit. And I think just knowledge, again, is your best tool.
Yeah, very good. And remind us again where people can download this guide that walks them through the buckets.
Yeah, so it's at www.risingfemmewealth.com/mindful for your Mindful Fire podcast. And it is the Tax Smart FI guide. And so you'll see a lot of the things that I talked about today and the tax bucket planning strategy. I have the buckets laid out there with the different forms of income. And then I also show an example of the $0 tax plan for the financially independent couple with 2 kids that I talked about too.
Perfect. I will be downloading that as soon as we finish recording. So I recommend you all go and check that out as well. One last question on tax planning. When do you do tax planning? Because it sounds like it takes quite a bit of forethought to actually implement these strategies. Not something that I would describe as my strong suit. So how and when?
So I actually have a spreadsheet set up with my 3 tax buckets, and I usually start looking at it in the winter of the year before I'm doing my tax planning. So I'll start looking at it in like November, December, say 2024 for the year 2025. And I start setting up my tax buckets. One of the reasons that I do that is because I use the Affordable Care Act for my healthcare. And so I have to estimate my income to apply for those plans, and that's in December. So I have to have a pretty good idea of what my income is going to be. So I have to go ahead and get all my tax buckets set up and say, okay, this is what I'm expecting with like dividends. Are we selling a property this year? Can I offset that with any losses? Like, I have to really have that nailed down pretty well. And I know that's hard, like, especially if you have a business, right? To kind of know what's my income going to be. You have to estimate. But I recommend starting then. Start before the year. And then as the year goes on, you can refine your buckets and see, okay, are there some other levers I can pull? Do I need to do some tax loss harvesting? Do I need to contribute to a 401k or an IRA? The great thing about contributing to an IRA is you can contribute until April 15th of the next year. So once you've already maybe gotten your taxes together, you can say, oh, I need to make this contribution to lower my my tax bill. So you have a little more flexibility there. Unfortunately, you can't do that with the Roth conversion. You have to know by December 31st. A lot of people like to do their Roth conversions up front in the year because it gives it more time to grow tax-free through the year. You just have to make sure if you're going to do that, you might need to pay quarterly taxes on that. Yeah. I think a lot of people who have businesses also, they're doing a lot of estimating too for their quarterly tax payments. So people are probably even doing more tax planning than they realize. Even when you set your 401k contributions at the beginning of the year, you set all your deductions, filling out your W-4 for your employer and determining your dependents. All of that is tax planning. So I think you're actually being more proactive probably than you even realize, even if you don't have a spreadsheet and you're tracking everything immediately.
Got it. I think you'd be shocked to see where I'm at. But there are some things that I do and more that I can do. And saving money on taxes is a good incentive to actually start doing those things. So Susan, let's switch gears now into what I call the Mindful Fire Final Four. Are you ready?
Yes.
All right. So the first question is all about envisioning. So we talked about how you're financially independent, have this business, gone deep down the rabbit hole of tax planning. But we didn't talk too much about, kind of what your life looks like. We talk a lot on this podcast about envisioning and thinking big about your life and what you want, the life that you want to create. So I'd love to just hear a little bit about your vision for your life and for Rising Femme Wealth, and what's your big vision for life?
Yeah, that's a great question. So this is interesting because one of my sons goes to a Waldorf school, and as part of their pedagogy, they see life as divided into periods of 7 years. And so they don't start elementary school till they're 7. Like there's these big transition periods of 7 years. And that's something that I also kind of feel in my own life. I mean, 7 years is enough time to get a PhD and completely transform your life, right? It's enough time for your kid to go from elementary school to college. Like your life can completely change in 7 years. And so I've started trying to envision eras and seasons in my life transitioning. And I feel like we've been in the season of travel. So we left our jobs. We spent a month driving through Southern Africa with the kids. We spent a month in Japan. We went to Chile, Patagonia. We spent a few weeks in New Zealand. We've been doing just a whole lot of travel with them. And I feel like now we're moving into a different era. They're getting older, and so we can't pull them out of school as much. And so that era may be slowing down. And we're transitioning maybe into, I don't know that we'll do like traditional work, but we're definitely doing more, at least side hustle activities than we were doing before. So I'm working on Rising Femme Wealth. We've got, our Wealth by Design program. And then I'm also finishing up my enrolled agent certification. That's very similar to a CPA. I've got one more exam left to take on that. And that'll give me the ability to do even deeper tax planning work with people and actually represent them in front of the IRS. My husband he's very handy. He does all the maintenance on our rentals. And so he's actually started doing some handyman work for neighbors. He's thinking about running workshops for men to teach them how to do handyman things around the house, install an outlet, install a faucet, which I think would be really rewarding for him. Cool. Yeah. So we're shifting from we've been very focused on the children, right? And now they're 11 and almost 14. And so I feel like we've got this new shift coming where we're going to be focusing more into, okay, what can we really do with our life? And you and I have talked about this previously, that it's hard sometimes in the financial independence movement when you do have young kids, because it's like you're not free, right? A lot of other people in the movement, their kids are grown or they never had kids. They have a lot more freedom to just pick up and go wherever, whenever. And so kind of shifting through those seasons with the children and kind of finding our identity in each season is a big piece of that. And where we're at now is, what is our identity looking like now that the kids are getting a little bit older?
Got it. Very cool. All right. The second question is, what piece of advice would you give to someone early on their path to financial independence?
Yeah, I would say really take advantage of that low hanging fruit that I was talking about with the tax advantaged accounts. If your income is low enough, you're in a low tax bracket, go ahead and take advantage of contributing to a Roth IRA. Make sure you're getting the match at your employer for your 401k. That's essentially free money, right? It's part of your salary. And I see so many new employees, and I was one of them too, right? I was like, retirement is way down the road. I want the money now. And I didn't realize that was part of my salary package, that match that I wasn't getting. I was letting them keep it. So that's really important to take advantage of that 401k match, especially early when it has time to grow. Take advantage of an HSA if you have the opportunity to do that. And maybe even when you're young, go ahead and take that money and invest it within that HSA account instead of just keeping it in cash. Let that grow tax advantaged for a longer period of time if you can afford to not spend that money on medical expenses at the time. So I think there's a lot of things you can kind of do up front to front load your success for later on.
Yeah, absolutely. Time and compounding are very powerful.
Yes.
All right. The third question is, what piece of advice would you give to someone getting started with meditation and or mindfulness?
Yeah. So I feel like with finances, there's two different areas where you can really be mindful. One of those is your spending, and one of those is your investing. So the easiest one when you're first getting started is really having like values-based spending, really focusing on that. Like, what really brings me joy? What are the things that I want to spend my money on that are worth spending my money on? That can really set up your life to be working in a good place. And so I think there are a lot of things that society tells us that we're just supposed to have, right? A nice car, nice clothes, lots of makeup. Like, you see all these things on TikTok, right? Everyone has to have this. But what do you really want to be spending your money on? And where can you save money? What is not really that important to you? So for me, travel that's something that really means a lot to me. And I'm willing to spend money on it. Going out like for lunches with friends, like that's something that's important to me. That's community, right? I'm willing to spend money on that. For me, having the fancy clothes and the fancy cars is not as important to me. And so when I look at my values, it's like, okay, well, that's where I can be saving my money. I can build my nest egg. And so I think this helps sort of establish this life where you don't feel like you're losing out by working towards financial independence, because you're still spending on things that align with your values, but you've cut out all the things that don't align with your values. And that's where your nest egg can start to build from.
Absolutely. Yeah. I think that really is an early thing that you can do in a way that you can bring mindfulness. The reason I started this podcast is to explore the intersection of mindfulness and financial independence. And that intersection is awareness and choice. You just need to be aware. What am I spending my money on? What do I value? What do I care about? And then you can choose to keep spending the way you're spending, or you can choose to shift and spend a little bit differently and more intentionally. And you can always start again. That's another big aspect of mindfulness, is that you can just start again. You can come back to the breath when you're meditating, and you can come back to your spreadsheet or your, not Mint, because Mint's gone, but whatever you use, Copilot, Monarch Money, whatever it might be, a spreadsheet, and just start again. Choose what you want to do going forward.
And this is something we work with a lot of women on, is forgiving themselves for something that's happened in the past and moving forward. A lot of women come to us and they're very ashamed of some bad money decisions that they've had in the past, or they're ashamed that they haven't been more involved with their finances or taking control of the finances. They're ashamed that they don't even know where their money is. And so a big part of what we do is work with them to release that shame and say, here's where you are now, and we're moving forward. The past is in the past. Like you're saying, you can start from here and move forward. And we're going to take a deep breath and we're going to move forward. We're going to look at your accounts, figure out where your money is. You can do this. It's been so empowering, even for me, to see these women become empowered around finally realizing they can do this.
Yeah, I love that. It really ties full circle to where we started in this conversation. We can't beat ourselves up for things that we did in the past. We need to just meet ourselves where we are with mindfulness and choose how we want to move forward. and we can do that at any time. The last question, Susan, is how can people connect with you online, learn more about Rising Femme Wealth and your work there, and just how can people follow along with you on the internet?
So again, my website is www.risingfemmewealth, that's FEMME.com. We have some resources on our website. If you go to our website /mindful, you can find the Tax Smart Financial Independence freebie that goes over a lot of what we talked about today. Caitlin and I have our Wealth by Design program, which is on demand with monthly in-person group coaching calls. And then you can also book individual coaching sessions with us on top of that. And we love working with women and talking financial strategy, tax strategy, and would love working with anybody. So thanks.
Absolutely go check out their website and get that free tax planning guide. I'm going to get it right now. Susan, thank you so much for being here. Absolutely pleasure to talk with you. And I really appreciate you going into all that detail on the 3-bucket strategy. As I said, I'm going to get that guide right now, and I suggest everybody goes and gets it as well.
Thanks so much, Adam. I really appreciate you having me on, especially to talk about taxes, which I know is usually not people's favorite topic, but it's so important on your wealth building journey. So I really appreciate this opportunity.
Thanks for joining me on today's episode of the Mindful Fire podcast. If you enjoyed today's episode, I invite you to hit subscribe wherever you're listening to this. This just lets the platforms know you're getting value from the episodes and you want to be here when I release additional content. If you're ready to start your Mindful Fire journey, go to mindfulfire.org/start and download my free envisioning guide. In just 10 minutes, this guide will help you craft a clear and inspiring vision for your life. Again, you can download it for free at mindfulfire.org/start. Thanks again, and I'll catch you next time on the Mindful Fire podcast.